ski instructors who were permitted to charge their meals had run up an account of $870. Run up an account, that means what? They were utilizing the credit facilities of the cafe. Credit facilities means they were eating up, paying at some later stage out there. Simple credit facilities. The cafe was extending credit to the ski instructors. That is, you eat, you can pay once in a month, whatever is the day. I will keep an account, pay once in a month. So that is what it is. So as of 30th of March, ski instructors owed the cafe $870. I'll repeat. As of 30th of March, ski instructors owed the cafe $870. Now what happens? If they owed the cafe $870, then it becomes what is called as a receivable from ski instructors. Receivables from ski instructors out there. When I say receivable from ski instructors, what is the amount? $870 is the receivable that I have from ski instructors, and that is where it is an asset. One can argue with me, sir, why are you taking it as a receivable? The statement clearly says these accounts were subsequently paid in full. Read the statement. These accounts were subsequently paid in full. Now what happened? As of 30th of March, did they owe the cafe? Yes, they owed the cafe. They paid, subsequently they settled it. Perfectly alright. I am not worried about subsequent. But what am I worried? I am worried about preparing what the company owned and company owe as of 30th of March. So as of 30th of March, the cafe was to receive $870 from what do you call it as the ski instructors out there, and that is what I have recorded out here. The next statement if you read, it says the Lone Pine Cafe owed suppliers amount totaling 1583. That means what? You owe the suppliers how much? 1583. When you owe the suppliers, what it is? It is a liability. That is whatever amount that is the owed. Whatever the creditors we call it. That is what for supply creditors of supplies. How much is it? $1583. That means you owed 1583, you have to pay. You have to pay means it's a liability for you. It's a liability, and that is what I have clearly written out here. Read the statement further. Mr. Simpson estimated that the depreciation on the asset amounted to $2,445. The asset, when I say the asset, what is the asset? The asset was 53,200. The asset was 53,200. Now, the asset has depreciated out there in this particular case. The asset had depreciated in this particular case by 2,445. That means what? The value has been reduced. That means the $2,445 worth of value of the asset or the equipment has been utilized. The equipment is worth only 50,755. The equipment is only worth about 50,755 because the equipment was 52,3,200. $2,445 worth of the equipment I have utilized during the period November 2nd to March 30th, November 2nd, 2009 to March 30th. So, the equipment has reduced in value by so much. Sir, why are you saying? It says the statement clearly says that is that depreciation on the assets. So, why are you taking it only for equipment? It can be for cash register also. Yes. But since equipment is a larger chunk present there, I have reduced it from the equipment. That's all. That means what? There is an asset. The asset has reduced in value. As of 30th of March, the equipment is worth only about 50,755, and that is clearly what I entered. The value of the equipment as on the day you are preparing what is called as the balance sheet. That is the value of the assets and liabilities, the value of what you own and what you owe as on the date you are preparing the balance sheet. As on the date, the equipment was worth only about 50,755, and that is what I have written here. Next statement I am going to read in this case. Food and beverages on hand were estimated to be worth about 2,430 out here. So, food and beverages $2,430 was the value of the food and beverage that was there on 30th. Sir, here you had said in the opening balance sheet, you had said food and beverage 2,800. What would have happened? You have bought more food and beverage. I don't know, whatever it is. What am I recording? What I own, what I owe. On the 30th of March, the food and beverage that was there with me is worth only about $2,430. That's all. On 30th of March, the food and beverage that was there with me is worth only about $2,430, and that is all what I have recorded. Moving further from here in this case, during the period of operation, the partners' due salaries had agreed upon amounts, and these payments were made up to date. When the payments are made, the impact is on the income statement. Why do you, when the payment is not made, the payment is due. Yes, the balance sheet I will show that it is liable to pay. When you have paid everything up to date, there is nothing that you are liable to pay. So, what happens in this particular case? That is, you have made the payment. Do you owe any amount and salaries as of 30th of March? Nothing. When you don't owe anything, what happens? There will be no entry with regard to that in the balance sheet. As of 30th of March, do you owe some money in the form of salary? No, you don't, because you have settled everything up to date. When you don't owe, no impact on the balance sheet. Sir, when it is paid, the cash should have gone down. Agreed. The day it was paid, the cash would have gone down. But and after paying all that, we know that the cash on 30th was about $311. That obviously end of the day, and that is what we have taken. So, as of today, when you pay, if you pay, there is something you owe. You in this particular, since you have paid, there is nothing more that you basically owe, what is called as the to the partners and so on and so forth out there. I read further in this case. The clothing that Mr. Anthony left behind was estimated to be worth $750. Now, what happens? There are two versions. Somebody will say, sir, take it as an asset because clothing. Now, please note, is the clothing owned by the cafe? It says personal clothing left by Anthony. So, when it is a personal clothing, it is his asset, his property. It is not the property of the cafe. When it is not the property of the cafe, when you don't own it, please don't even record it, because we record what? We record only what the cafe owes and what the cafe owns. In this particular case, the cafe does not own that $750 worth of clothes. Another argument can come from your side. Sir, he has stolen the cash register. Let me take the 750 rupees worth of $750 worth of clothes and at least offset it for at least part of the value of the cash register. You don't have to do that adjustment, because two wrongs don't make it a right. If he has stolen, you will also steal his clothes. No, two wrongs don't make it a right. You ask for that is not for you to decide. That is the clothes belonging to him, and it is his right to do whatever he wants. Till he comes back, you keep it. After a certain period, whatever you hand it over and then put it out there. That's all you are. It is not the cloths owned by the cafe. It is not the cloth owned by the cafe. So, it will not appear anywhere in the asset side of the balance sheet of the cafe. To be even more precise, supposing the clothes it had said, there was one more additional statement. The clothes were the special equipment provided to Anthony by the cafe for working in the kitchen. Special equipment, special clothing to work in the kitchen provided by the cafe. Then what happens? It will become an asset of the cafe, because the clothing is owned by the cafe. The cafe has provided him out there. In this particular case, it is a special equipment provided by the cafe. In this case, it is his personal clothing. you have no business to take it as an asset of the cafe. You have to just leave it there. It is not an asset of the cafe anymore. It is not an asset of the cafe. It will not find a place in the balance sheet prepared for the cafe. Next, the partnership had also repaid 2100 of its bank loan. Whatever it is, 2100 of its bank loan. What is the bank loan? Bank loan was 21,000 out there. The bank loan was 21,000 out there. Now you repaid 2100 of it. That means how much you owe? 21,000 minus 2100, that is 18,900 is all that I owe to the bank out there. I have repaid. When I have repaid, I owe only about 18,900, and that is all what I owe out there, and that is all will be a liability side of the balance sheet. Now going further in this particular case, there is one aspect I left, that is what we call it as the operating license, is what I have basically left out here. The operating licenses is what I have basically left out here in this particular case. Now what is this operating license? Let us see, let us read this statement. The operating licenses. The operating license in here, when you opened the cafe, was you paid 1428 and it was worth 1 full year. As of today, March 30th, what is the value that is still left? I utilized that license for the month of November, December, January, February and March. That means I have utilized the license for 5 months. That means about 7 months worth of license is unexpired, can be utilized, can be sold, etc. That means the operating license out here, which was 1428 in this particular case earlier out here, which was basically 1428. This was for 12 months, and I see that license worth about for 7 months is still unutilized. I still own it. So what happens? It's an asset for you. So license value worth about $833 is still an asset for you, which can be utilized. So I will write it as an asset in the balance sheet. Now what am I looking at? I am going to look at getting the total out here and trying to see if the balance sheet is balancing out here in this case. Unfortunately, we see that the liabilities per equity is 68,483, my assets is 57,629 out there. Now what happens? Why is the difference? I said that every entry will find a place in 2 of the 4, the income, expenditure, asset, liability. Here I didn't do income and expenditure, and we have done only these. Why is the difference? Many arguments come in. Sir, we have not taken the salaries, we have not taken the purchases of the cafe, we have not taken the sales revenue what they have got, so many things. I am not worried about all of it. I am worried about here what you own and what you owe, your sources and utilizations. That is all what I am worried about. Now I will take an example. Having said this, I am going to take an example out here. Now let us supposing say in this particular case, case out there, I start a company out here. I am going to say liability plus equity and an asset. I start a company. I have put in contributed capital of $100. That means the cash that I will have is $100. Capital and then $100, cash becomes $100. I utilize this cash and buy raw materials. Now what happens? My capital becomes $100 same, my cash has gone out and raw material is an asset that is about $100 out. I utilize this raw material and then make some toy out there, and then I have made a toy and it is still lying out there in my godown out there, and then it becomes what is called as the raw material is not existent, there is a finished good FG that is existing. The finished good is a toy. Now one of my friend comes to me and says, wow, fantastic toy, I will buy this for $140 out there. So what happens? The finished good goes out there, and then what happens? The finished goods again come back, and then it gets converted to the cash out there for me. And cash of what? It is not finished goods gone means $100 gone. The cash what he has given is given me $140. So if we actually see carefully, the source of fund was only $100 for me, capital. I made a efficient utilization of the source of fund by converting from cash to raw material to finished goods, and then back to cash again. I made a efficient utilization of the money. So this $100 all our capital that was there, which is in the form of cash out here, I have enhanced the value of this to $140. I have enhanced the value of this for $140. Supposing the same case, I will tell you, it was the other way around. Let us say, now assets and liabilities out there, liability plus equity. Now I contribute capital out here, capital of $100, now cash of $100. The cash becomes raw material becomes finished goods. Now when I sell the finished goods, somebody says, oh, the toy looks so lousy, it looks like a monkey, it looks so lousy, I don't want to pay more than $80 to it, and you also agree and you also get $80 out there, give the toy and get the $80. That means when you give the toy, finished good goes, then what happens? Cash comes in, the $100 goes, and what is the cash you have received? You have received about $80 cash out. In this case, what has happened? The source of fund is exactly the same, but only thing is in the process of converting the cash to raw material to finished goods, and again back to cash, I have destroyed value of that $100 by $20. That is, I have destroyed value. I have destroyed the value of it by $20. So what happens? In the earlier case, the $40 extra I have made becomes what is called as a profit. Profit belongs to whom? To the capital provider. So I am adding it $40 to the capital provider out there, and then your balance sheet will balance. In this case, what happens? The capital was 100. Now the 100 has reduced by $20 out there. 100 has reduced by $20 because of what is called as loss out there. There is a loss, and then that is $20. That means the capital which was $100 now is worth only about $80 out there. Now again your balance sheet will balance. So take it, what did we say? All this whole thing out here is what I call it as sources of funds. This whole thing is what we call it as utilization. So in short, if I have to go back in this particular balance sheet out here, all these are what? Sources of my fund. My sources of my fund is worth about 68,483, but I have utilized this 68,483 in such a way that I have been able to generate value of only 57,629. That means I have made an inefficient utilization of the money that I have. So what has happened? I have destroyed the value. If I have destroyed the value for whom? The capital providers, I have destroyed the value. They have lost money. So in the whole process, this basically becomes what you call it as net loss out there. If you actually carefully see this, the difference amount is nothing but what you call it as the net loss in the process out there. 57,629 minus 68,483 basically becomes a loss out there. Moment you do that, the balance sheet balances. That means what? The capital was 32 plus 16, 48,000. Now the capital has basically come down in the process out there. The total capital in this particular process has come down. What is the value of the total capital? That is, the value of the total capital is only about $13,146 out there. $13,146 is the value of the capital out there. So the balance sheet is not balancing. Don't worry. That is just because of your that is, it is totaling this whole thing again. 1 second. That's all. So what has happened? The entity, these are all what is called as source of fund. Now I have made, this is how we have utilized. I have made an inefficient utilization of the fund. That is where the source is more than the utilization. You can actually see in this particular case out here. What did we see? The source was $100 out here. I have generated value only of $80. That means the source is more than the utilization. So what happens? The money what you have, you generate a loss out there, and that is exactly what has happened out here. So the sources of fund, you make an efficient utilization of the source of fund, like in this particular case, you generate profit. You make an inefficient utilization of the funds, then you make a loss out there. That's all. So in this particular case, if you actually look at this particular this case out here, there is, these are all the sources of fund. They have made an inefficient utilization of fund. So it has basically led to a loss in the process. It has basically led to a loss in the process. And moreover, you can say the loss, how are they going to divide it? They are going to divide it equally, because they are going to divide the loss or profit in the proportion to the capital, and each one of them provided the same capital, so they will have to divide it equally out there. Sir, how is creditors of supplies a source of fund? Creditors of supplies is a source of fund. What has he done? He has not given you cash. He has given you, instead of cash, the material for you to utilize, raw material. When he has given raw material, is it not a source? You can borrow, take cash and buy the raw material and keep it. Instead of you buying the raw material, he has given you raw material and he has not taken money for it. So is he not a source of fund? Yes, it is a source of fund out there. So all these are basically what we call it as sources of fund, and all these are utilization of the fund, how the money has been utilized. And in this particular case, unfortunately, what you see an inefficient utilization of the fund, and that is what has led to a loss out there. That is what has led to a loss out there. Now what is the 3,618? Nothing. The loss I have divided by 3. That is, each one of them has to bear a loss of about 3,618. As the third question says, what is the capital for each one of them? Now the capital for each one of them now is basically the capital each one of them have is basically what is the amount of money. Their capital, though they contributed $16,000, their capital is worth only about 12,382. You can divide by 3, this also by 3, same. Their capital is worth only about $12,382. They contributed 16, but today they are contributing, the cash is their capital, the capital is only about $12,382 out there, and that is what it is. Now these are all sources of fund. Sir, suppose if it is a profit, net profit here you had made a net profit, you would have added some money. How does it become a source of fund? Profit belongs to whom? Belongs to the shareholder. Moment I make a profit, I have to give it to the shareholder. I am not giving it to the shareholder, I am retaining that money in the company for the expansion. Then what is that? It is a source of fund. Source of fund divided and given by the partners out there. That is how we call it as source of fund and utilizations of fund. So now this entire thing, instead of liabilities and equity, I will say sources of fund. This entire thing, assets, I will say utilization of fund. Utilization of funds out there. Sources of fund and utilization of fund. You have made an inefficient utilization of fund. your source is more than your utilization, value of the source is more than the utilization, you obviously will stand making loss out there. The value of your source of fund is less than the utilization. That means what? Utilization, you have made a efficient utilization leading to profit, exactly like what you saw out here, this 80 and 20, 80 and $100. So, normally this is what we call it as sources and utilization of funds. So, if you look at the question out there, we have answered all the three. That is the first question we completed, second one we completed. Disregarding the complications, do you suppose the partners would have been able to receive a proportional share of equity determined in question number 2 if the partnership was dissolved? Yes and no, let us not debate on that, but what is the value that they would have received? The value what they would have received I have calculated out here, that is they had contributed 16,000, each one bears a loss of 3,618 and minus that is what they will basically receive in the process.